The next piece of the jigsaw is what Warren Buffett describes as the most important principle of investing. In fact, it's not just Warren Buffett. Many of the top investors in the world will tell you that the most important principle around investing is the asset allocation. So what do I mean by the asset allocation? The asset allocation is the split of the investments across the different areas. And the reason this is so important is that research shows 80 to 90% of the returns you get will be driven from the asset allocation. Whether you've picked the best investments or the worst investments, it will be 80 to 90% of the returns you get will come from the split of the investments that you had. So the asset allocation is absolutely vital. And it's that split that determines whether you've got an efficient portfolio, and it also determines the risk that you're going to get, and therefore probably the returns that you're likely to get. So it's absolutely vital that you have a properly diversified portfolio. There's different areas that a portfolio could invest in. It could be there's some stocks and shares in there. It could be bonds, which are loans to governments and companies. It could be cash, there could be property, there could be commodities. But you need a properly diversified portfolio across your investments to get the best returns possible for any given level of risk. So one of the other principles you may read about in the newspaper is that it's never worth picking active investment funds for your portfolio. So what do I mean by that? Well, quite often the newspapers will say, just put your money in a FTSE tracker fund. Most investment funds don't outperform their relative index like the FTSE 100. So just stick it in a cheap tracker fund and be done with it. And I think if you're going to pick your investments yourself, there's a certain degree of merit in that. But when it's done properly, you don't need to stick to passive investments because it can get you better returns. So we've been using the same investment managers for the last 6 years for some of our clients. And what we've found is that we've been looking at this every quarter for 6 years. And without fail, every quarter, the longer term returns have been significantly better by having active investments in the portfolio. In fact, this is the chart that shows it. So what you'll notice here is that from middle level of risk, and bearing in mind on this chart, you've got risk on the bottom, on the horizontal axis, and returns, annual returns on the vertical axis. Then what you can see here is that the green line is the passive investments. So they're the ones, that's a blend of investments like the FTSE tracker. So that's only ever going to follow the index, but the charges are low. And then you've got active funds. Active funds are where a manager's trying to beat that relative index, but you're paying higher charges for the privilege. So when done properly, as you can see, this has been the case, then what we've seen is around 2% per annum additional growth, depending on the level of risk, from the active approach to the passive approach. And this chart is taking account, this is after charges, so it takes account of the fact that the passive are cheaper. So what you're seeing is that actually, if it's done well, you can get better growth by finding a manager that can pick good active investments. But what you'll also notice is for each respective dot on this chart, the active line, which is the blue line at the top, this respective dot is slightly to the left of the equivalent green one. And what that's also showing is that not only did the investors that went into the active approach benefit from better returns, they also actually experienced less risk. Even though the split, the asset allocation, was exactly the same, they experienced less risk. So when done properly, if you're going to seek advice, then actually it is worth considering using a properly actively managed portfolio. Now, just to get you thinking again, you may want to go back to some of the questions that we ask our clients when we first meet them. So one of the questions that we ask our clients in our first meeting is, if you went to see your doctor and your doctor said that you'd got between 5 and 10 years left to live. Now, you're not going to feel sick during this time, but equally you're not going to know when your time is up. How would you live your life differently now? So you've got 5 to 10 years left to live, you're not going to feel sick, but you're also not going to know when your time is up. How would you live your life differently in that sort of situation? Giving thought to these sorts of processes starts to give you a better understanding of what's really important to you in the future. So going back to the radical investment approach, I mentioned already the importance of discretionary management, or the fact that we've looked at a properly diversified discretionary managed portfolio. Really, for me, this is a vital change that we made to our business 6 years ago, because we used to build our own investment portfolios within Efficient Portfolio, and then 6 years ago we made the decision to go out and find our clients the best discretionary managers possible. Now, if I'm completely honest, when I was managing our own investment portfolios, if somebody had sat in front of me and said, I think the guys down the road are doing a better job than you, I'd have probably, I wouldn't have, and if I believed that, I still wouldn't have told them, because ultimately I'm basically sending the clients away. And I didn't think at the time I was being truly independent. By now, but the way that we think it should be done now is by advising the clients to say, well, okay, out of all the investment managers in the market, we think this is the best one for you. It allows us to be truly independent. It means that we can find the best investment manager for the client. But if at any point in the future they're not delivering the returns that we expected, then we'll be the one sitting on the same side of the table as the client saying, absolutely, they're not doing as good a job as we thought they would do. We need to change tactic and move to these guys. So for me, if you're going to a firm where they're picking the investments themselves, then you're asking them to mark their own homework. Whether that's by going direct to the bank, direct to a big firm of financial advisors that have their own investments, ultimately you're asking them to mark their own homework. And they're never going to sit in front of you and tell you to sack them because the guys down the road are managing the money better. So be warned. And that's why I believe that discretionary management is the only way that you can get truly independent advice. So the next stage of the radical investment approach is actually compounding. But we've already covered this earlier on in the smart savings solution. But it is so important that it features in both, because getting that compound growth is just really important to get you to financial freedom as quickly as possible. But I'm not going to dive into any more detail here on it.